Alrighties. What a beautiful Saturday morning for me, and then a beautiful weekend for you guys. Thank you for taking your time and coming into this bootcamp, first of all. You're making a big effort into improving your own situation, your own position in what you're trying to achieve, and I respect that. Okay. So for many of you that didn't notice, we have actually changed our logo, right? Any feedback? How do we like it? Do we like the new logo? So as you know, we're changing and we're rebranding to Timeless Finance, which is going to be a new direction that we're heading with the advisor. And this is one of the new logos that we have kind of shortlisted, so I'm testing it out. Do you guys like it? Yeah, it's sick, love it, cool. Okay, quiet bunch today. Interesting. All right, let's do a quick check-in question with everybody. So I want everybody to answer this, and I'm gonna lay some ground rules right off the bat here because it's super, super important that we get to a level of understanding before we even embark on this journey, okay? If your intention is to be in this bootcamp and not participate, that's not gonna be good. That's not gonna work because participation leads to a higher sense of learning. I know this because I've been teaching for the past 3 years, and I have realized that the best students learn when they are engaging, okay? So even though it's very difficult for you to perhaps pull up the chat and engage, or you don't know how to pull up the chat, look down in the Zoom control panel and find the chat icon. Tap on the chat icon and engage with everybody that's here. If you don't choose to engage, what's going to happen is you're going to be in your own silo and you're not accepting to new ideas. You're not accepting to creating a conversation. And that's the first step to improving your position, okay? So engage. If you have questions, note them down. I will cover all the questions at the end of class, okay? I will stay behind for as long as it is necessary for me to cover all the questions that you have, okay? And if you have anything to say in between, also put them in the chat. If I see it's something that I can answer quickly, I will answer it quickly. If it's something that I know is going to take more time, know that I'm reading the chat and I will answer it later, okay? So both ways, I want you to get involved in this participation, because if you don't, it's not going to be that engaging, okay? So I have a check-in question for you guys today. What do you want to leave this session with? That could be answered many different ways, okay? So go ahead and write what you think is something that you want to leave this session with. By the way, are you guys able to see my video? Like me, actually? Very quickly. Establish a foundational trading strategy, exit strategy, and enhance discipline. Finance isn't scary and I can take control. New details that I'm not aware of yet. Better understanding of types of strategies for swing traders. Okay. A high level of trading competence. Okay. That's good. Okay. These are all good ones. Great. Any more? No, that's it. There's 36 of you here. Drum up courage to pull the effing trigger. I like that one. Understanding of what stocks to invest in. Okay, very good. Increased confidence in my decisions to trade or not to trade. Same as Jack. Okay, cool. Once again, I'm trust me, you guys might think you're gonna be under the radar and not engage. I will call you out if you're not engaging. I will, I definitely will. Because I need you guys to participate. If you're not gonna participate, it's as good as you're not gonna be here. You know what I mean? Learn to read charts better. Okay, better understanding evaluations. Okay, cool. More trust in myself and the data price action. Okay, cool. Understanding market cycles. That's a really good one. The right trading psychology. Good. Okay. So you can see that all of you come from a very, very different need. This is one thing that I need y'all to understand, right? Everybody has a different need here. Everyone's looking for something different. There are some of you that are looking for trading information. Some of you are looking for investing information. Some of you are looking for psychological help, right? And the good news is we're going to cover all three today. So I want to definitely start this session off by going through a very important preface to this entire bootcamp, okay? And that is the hero and the ego. And I think if you have been reading the newsletters that I've been putting out, and if you don't have access to the newsletters, then you can obviously reach out and I'll give you access to the newsletters. But in one of my recent newsletters, I wrote about the hero's journey. Okay. But what I did not talk about was the hero's journey with the interplay of ego. Okay. Because you see, no matter where you are in your journey, right? Wherever you are today, the one thing that is stopping you from reaching the next point in your destination is your ego. Okay. And why is that so? It's because the human brain is designed to protect itself. For those that are not aware, your ego constantly jumps in front of you to take the position of a protector role when you are going through a self-realization journey. This is the reason why many people who are embarking on the role of going into things relating to finance find a very difficult time doing so. So in the stage one of the journey that most of you are facing, you experience complete paralysis. And this is when your ego is at its highest, okay? The reason why this is so is because you're unable to see past the fact that there is something out there that can be of good to you. Your self-serving belief at this stage is that your own decisions will get you to your success. Okay? This drives you in a constant cycle where you are fed back to the beginning position, where you think you know it all, you think you can't possibly find a better solution out there that will teach you, but you are refusing to seek for any help to do so. Okay. And this is also driven by a fear of failure. Once again, where does that fear of failure come from? It comes from the fact that you think that when you are going to embark on this journey, you're gonna fail. So what do? You choose the easier pathway, which is to stay where you are, right? And what does that mean? That means your ego jumps in front of you again, right? Your ego is playing tricks on you once again, right? It's saying, you know what? This is too hard. I don't know what I'm doing, where I'm at. Therefore, I'm going to stay where I am. What are you doing in that case? You're protecting yourself, right? This is your ego protecting you, okay? Now, remember, it's not always your fault. And no way am I blaming you for this. No way am I saying that, hey, this is a you problem. No, that's not what I'm saying. What I'm saying is you need to have the self-awareness to know this is happening to you, because that is the first step in accepting that there is a solution. Okay? Now, in the second stage of this journey, you have some willingness to move, but your ego is still a bit high, right? You have anxiety, a lack of structure, accountability. All these things cause you to stay in which part of your journey that you are. And when you are in this part of the journey, what happens is, even though you may be accepting towards new ideas, you don't have a structure around it, right? So because of the lack of structure, it causes a couple of different problems. Problem A, the lack of structure causes a accountability feedback problem, where you're not being held accountable and you are on an endless journey of consuming information that is not serving your higher purpose. Number two, you are stuck in a position where you just can't see the end result. You don't have a goal. So what are you working towards, right? And this, once again, kicks you back to stage one, right? So all of this leads to you being on towards the journey to stage three, which is where an individual is now ready to grow. You realize that from this entire process, right, you were not ready to grow yet. But when you reach stage three, that's when you are somewhat ready to grow, okay? And in stage three, this is where an individual's ego starts to drop, okay? This is where they admit that they need to find help. They admit that failure is what is causing the relapse. But the problem is that when failure happens, they give up. Okay. So this is part of the stage three's problem. It's a constant loop cycle in which an individual fears failure, goes through failure, upon the side of failure, goes back to stage one, right? And that's just a difficult thing to deal with. Now, if you can get past stage three and you realize that your ego needs to come down and you no longer are fully self-serving, then are you able to get into stage four, which is the hero's journey. And this is where you are embracing failure and fear as part of the journey, okay? This is where you are able to accept and find a mentor. A mentor finds you as well. And you hold the mentor accountable. The mentor holds you accountable, right? And what do you do together? You do a dance. There's a dance of egos, right? A dance of egos in which both of you are contributing to a goal that is in unison, okay? And you're using data-driven insights to iterate and improve. Okay. Now, I'm not saying that all of you need mentors. What I'm saying is that from what I have seen, that when someone realizes that they need help and finds that help is where the maximum growth happens, because that is where your ego is at its lowest. So out of these stages, where do you think you are today? I want to know this. I want to really know. Very quickly in the chat, spew it out. 1, 2, 3, 4. Go ahead. Three, four, the hero, 3, 4, 3, 2, 2. Okay. I'm ready for the dance of egos. Okay, more people coming in. We gotta let those people in. I'm at hero. Okay, no worries. You can change your answer. Okay, see, so there is a good mix of you, right? A very good mix of you. A lot of people you. And once again, I want all of you guys to engage, right? So if you haven't put down your answer, please drop it in the chat. I really want to hear from all of you. There's a whole bunch of 2s, there's a whole bunch of 3s, there's a whole bunch of people who are on 4s, right? Between stage 1 and 2, I'm willing to embrace stage 3. Okay, that's great. And this is the thing, the awareness is the most important thing here, right? Okay, great. This was a good exercise. I just want you guys to note this, and I want you to think of this throughout this bootcamp. Hold this information, right? When you're in stage 1, let's say you're in stage 1 or 2 or 3 right now, what I want is by the end of this bootcamp, all of you should be at stage 4. This is my aim. It's to bring all of you to stage 4 by the end of this bootcamp. Can we do that together? Are you ready to do that together? All right, let's get started. So I know that some of you may, be in the path where you already know some of this information, but there are others that don't. And for those individuals that do know this information, you should listen again. You might learn something new, right? I have made sure that most of this information is all unique and has been tailor-made for this bootcamp. There's new stuff here. Some things are from the growth investing and trading course. And so I'm going to share everything and let's get started. So first of all, majority of you that are on this journey have a big problem. What is the big problem? The big problem is you have jumped into trading without understanding what investing is. How many of you have done that? If you have been a trader before you invested in stocks, say that's me in the chat. I want to know how many of you have gone through this scenario, okay? And the reason why this is the big problem is because you don't have your feet wet. You don't understand what equity is. You don't understand what stocks are and what the basis of owning a stock is. Therefore, by jumping into trading, you are trading a product that you don't understand, right? How do you, if you are a wholesaler, for example, you own a shop, right? Let's say you own a Walmart. That's a very far-fetched example, but let's say you own a convenience store. If you don't know your products and what they are priced at, if you don't know the market price of this product, how are you going to compete in an environment where people are buying and selling constantly? Just think about it for a second, right? If you don't know what you're buying and selling, how are you going to buy and sell it, right? And yes, I get it. There are other mechanisms in the market that will allow you to perhaps benefit on arbitrage, which is the difference in pricing. But you need to understand what you are doing, right? And the difference lies between two very different people, because there is an investor persona and a trader persona. And in this case, I want to talk about specifically with relations to a stock like NVIDIA, okay? A stock like NVIDIA. So in a trader's perspective, what does a trader focus on? An investor's perspective. What does an investor focus on? The investor focuses on the actual value of NVIDIA. If you are buying a stock, right, what do you want to make sure? You want to make sure that you're buying it at a good price. Because I'm sure you have all heard this statement, buying a good stock at a bad price is as bad as buying a bad stock at a good price, right? And that's the thing. It's whenever you're buying into something that you're investing in for long term, you have to take into account what the value of this is with relation to market pricing, right? And how do we do this? How do we measure the value of a stock? We measure it by using the stock's projected cash flows. Now, I know some of you are already thinking, oh my God, he's talking finance lingo. I'm just talking about the money that this company is generating year on year, right? If you are going to take its projection of its future cash flows into the future, and then you discount the future cash flows based on how much it costed that business to earn that cash flow to the current day, that is how we derive at something called the intrinsic value of a stock, right? We know this in the basics of finance. For those of you that have taken a basics in finance course, you know this information, right? And if you don't, I'm explaining it for you. Now, for an investor, they will not buy NVIDIA until it hits a target price, right? And every time that NVIDIA will have a earnings report posted, what will they do? They will adjust their pricing target, right? This is why analysts are constantly upgrading and downgrading stocks, right? Because what are they doing? They are pricing the stock for their company that they work for, right? So a common thing you would hear investors say is, I know NVIDIA is worth $700, therefore I'll keep buying it on the dips. If it goes below 700, I'll keep buying it. If it goes above 700, I will stop buying it, right? And I just want to bring to your attention that as of yesterday, NVIDIA was trading at around $900, right? But what is the true value of this stock? The true value of this stock, based on my calculation, is between $822 and $950. This is the intrinsic value of NVIDIA currently, right? So if it is trading between 822 and 950, that is the fair value of the stock. Is NVIDIA trading between this price? Yes, it is. Therefore, should you buy the stock? No. As an investor, I wouldn't buy the stock, right? Because it is fairly priced. It's fairly priced. It's not trading at a discount, right? So why would I buy it? However, right? This is the difference between the investor mindset and the trader mindset. Now, in the trader mindset, things change a little bit, right? Because what do we focus on when we're talking about NVIDIA from the trader's mentality? We're thinking about the price action of NVIDIA on a daily basis, right? It's going up, it's going down, it's going up, it's going down, it's going up, it's going down, right? What we are trying to capitalize is the past trends or patterns and price action to determine its future pricing, right? And how are we doing this? We're doing this by mostly relying on day trading for income. Okay. So it is regardless of whether NVIDIA is overvalued or undervalued. What the intention here is to make smaller but more consistent profits as a trader, right? So a common thing you hear a trader say is NVIDIA recently hit 200 EMA, which is a strong support level, hence I will keep buying on the dips, right? It's very, very important to understand the difference between these two personas. And the reason why I bring up the importance of getting into trading for investing first before you get into trading is because there are some of you that suffer from a very simple problem. And you can tell me if this is right or wrong. You have an innate urgency for making money through the stock market. How many of you are constantly on the search for a quick method to make some side cash? How many of you? Be real with me. You can be real. Nobody knows you here, right? Nobody knows you. You can say what you think about yourself. As I said, drop your ego level. The more you drop your ego level, the more you're going to learn, right? So how many of you have this innate urgency that, man, I need to make some money quick, right? Because I got bills to pay, I got rent due, I need to pay for my nails, I need to go pay for a haircut, I have a dog, and this dog keeps pooping, and I need to buy, you know, more, I don't know, dog poop bags or whatever that it is, right? There's quite a few of you, right? Now, here's the thing though. If you simply shifted your mindset from having that mindset to an investor mindset, you will see your trader persona flourish. It is a simple mindset change. The reason for this is because with a trader mindset, urgency is your focus. With the investor mindset, patience and consistency and discipline is the focus. Can we all agree on that? Having a mix between these two makes you a formidable human. It makes you a person who has his emotions in check, has his mentality in check, has everything in a balance. You might not be able to do the balance yet, and that's okay. But this whole bootcamp is designed to teach you that there are other ways to think other than the way that is yours, okay? So why should you learn about investing and trading, right? Or why should you learn about investing first and then trading, right? The reason why you need to focus on investing first is because the only way for you to build wealth for your future is to start saving. This is the only way. I don't give a crap what anybody tells you in this world. You can go and listen to the godfather of, I don't know, economics or whoever it is that is going to tell you what they need to tell you. But everyone will never, ever tell you this one thing, which is in order to be a good trader, you need to start saving money. Now, I believe some of you already are on this process, right? You have a decent amount of savings, you put some money away, but some of you might be in the opposite end of this where you don't have any savings, and what you're doing is using your income to fund your trading. This is a big problem. You need to understand this, because if you aren't able to accumulate some assets that are going to give you cash flows, right? You are never ever going to be able to get out of the big bubble that you're in, okay? The reason why many individuals aren't able to get accumulating assets to produce cash flow is because they fail to save. And if you fail to save, you'll never be on that route. So what you have to do is, before engaging yourself in trading activities, which is the active investments part, you need to focus on investing first, which is getting a passive investment portfolio started. This keeps you grounded. and also keeps you out of FOMO. Let me give you a prime example, okay? Let's say about 2 years or 3 years ago, you started your saving journey and you put a bunch of money into the NASDAQ or the S&P 500, right? And I'm pretty sure some of you know what that is. It's the index fund, which tracks the entire stock market, right? And imagine if you had just put aside a little bit of money into NVIDIA as well, right? Maybe not a lot of money, maybe $1,000, right? At that time, maybe 3 or 4 years ago. And then you decided to start trading after that, right? Think about the two different scenarios here. Considering where NVIDIA's price is today, right? You wouldn't feel FOMO. Why? Because you have the exposure in equity, right? You bought stock. It makes a considerable mindset change in your head because you're not constantly thinking, man, I should have bought NVIDIA. Man, I should trade NVIDIA. Man, I need to keep buying NVIDIA. You are already invested. Therefore, you see your gains and you see, oh, I'm up 300, 400% on equity. It doesn't make you FOMO into things unnecessarily. Can we all agree on this? Saving early in your life and putting it towards compounding investments such as an ETF will generate cash flow, which is also dividends, which can be reinvested along with the long-term stocks that you buy, right? And one of the best way to do this is through dollar cost averaging, which is a investment style that most people would probably know, which I'm going to reiterate right now. This means that you buy an investment at a specific time every month, but you do it with discipline every single month. What happens here is your investment averages at a certain price and starts rising, right? And over the long run, it doesn't matter whether the market was up or down, you just hold a position of average prices, which allows you to be in a well-off scenario. Now, the other way is obviously you join EJ Discord and we tell you exactly when to go in and out, right? But this is one of the easiest ways, foolproof methods where, you don't even have to think, right? But remember one thing, timing investments are a fool's errand. Don't ever try to time it, right? I know that while I may joke around and tell you that join EJ's Discord and we'll tell you where to buy and sell, I'm completely joking about that, right? There is no perfect time. Remember, even I don't get the timing right? It's not something that I can tell you, oh, I have a prophecy crystal ball that's going to give you the answer, right? It's not true, okay? It's simply not true. Anybody who tells you that they can perfectly time the market is a fool, right? So when you try to time the tops and bottoms, you're going to lose out on the run. So that's just something that you need to understand. Never try to do that. Just average in tranches, buy when you can. The most important thing here is you need to start right away. Why? Because of something called compound interest. Okay. The reason why I'm bringing this up so early on in the bootcamp is because some of you are facing this urgency complex, and then the other part of you says to yourself that, yeah, you know what? I'm going to do it next month when I get some money. Yeah, you know what? I'm going to do it next week when I get some money. How many of you have been procrastinating starting your long-term investment portfolio only to look back at it 8 months later and be like, holy shit, I should have done this much sooner. And then at that point, you keep telling yourself, yeah, I'll do it later when the market comes down. And then it goes higher. And then man, I keep losing out. How many of you go through this? Right? You keep seeing the market go higher and higher and higher, right? And you keep seeing investments go higher and higher and higher, and you never invested. So therefore, you're constantly, what are you doing? You are serving your ego. Why? Because what happens is you are not putting yourself first, right? Grow with NVIDIA and cryptos, right? Okay, yeah, see, Jetnia, I appreciate you being honest with yourself. This is really important, okay? How do you feel about partial shares? Do it! The main thing I'm trying to tell you guys here is be consistent and disciplined every single month. You have to do it. It's a forced saving. Can you afford that bottle of Hennessy in the club? Can you afford that bottle of whiskey which you drink at home? Can you afford that bottle of wine that you have from time to time? Can you afford that dinner that you have with your friends when you go out from time to time? You can, right? Then you can afford a piece of the shares of the market. It's all a matter of allocating your capital in a responsible manner. Okay. So I want to show you a difference here on the importance of investing early. Okay. And this is directly from the Federal Reserve. Okay. This is from the Federal Reserve. You can see this. This infographic is from the Federal Reserve. And this is assuming a 8% interest rate compounded annually. This is the return of the S&P 500. What long-term investment yields 8% per year? It's the S&P 500, my dude. It's the S&P 500. That's adjusted after inflation is 8%. The actual return is 10% annualized over 25 years, just so you know. Okay. So for those of you that don't know this, the entire stock market, when you buy a piece of it, will return you 10% per year. And then when you net out your inflation, what happens is that you get to about 8%. And now I know some of you are going to say, but what about years when inflation is high? Well, what about years when inflation is low, right? There is a balance and a trade-off, and that happens, okay? When you start your journey, just with the difference, okay, look at this investor one. Starts the journey at the age of 25 and sets aside $5,000 a year for 10 years in a row. Remember, $5,000 a year, divide that by 12, that's $600 per month, okay? I know it might sound high, but she only does this for 10 years, right? And then after the age of 34, she just stops, no more. That's
Can
it.
you go get something?
Sorry, Victoria, do you mind muting yourself? Here, I'll go ahead and mute you. So remember, after 10 years, this person stops right away, right? Now, look at scenario 2, okay? Scenario 2 is this person starts at the age of 35, invests 5,000 each year for 30 years. For 30 years. For 30 years. For 30 years. At the age of 65, look at both of their portfolios. Okay. Investor 1, 787,000. Investor 2, 611,000. What I'm trying to prove here, the point before I move on to the next slide, is you need to start earlier than you think. Because the main thing here that makes a difference is the compounding of these people's time frames. One of the reasons why Warren Buffett makes $100 billion a year just on dividends, right, is because of compounding. All right. Moving into the next part. So I want to do a quick exercise with you after you have just learned this importance of investing. Congratulations, you have won $1 million through an inheritance. Okay. You have two choices to receive the money, and I want you to make this choice. Everybody here has to get involved. Okay. Choice A, you invest all the $1 million today. All right. You invest all $1 million today, and this is going to give you about 10% per year for 20 years. And choice B, you're going to invest a stream of payments in this case, because what has happened here is your cousin told you that, hey, you could just use a portion of that money and invest in his business, and his business will pay you $100,000 per year, and you will be investing the $100,000 per year over the next 20 years. Which choice do you make? Go ahead, put your answers in the chat right now. Is it choice A or choice B? And remember, use what you just learned in the previous part that I just engaged with you, right? Okay, great. Choice A. Jason says, I don't know. Pick one. It doesn't matter if you're wrong, right? Choice A, choice A, choice A, choice A. Okay, great. It sounds like most of you have the right idea, right? Just based on the previous information that I was trying to teach you, you can understand something here that obviously, if you take that same principle, now I know this looks like a lot of numbers and a lot of figures, but this is just the way finance is calculated, right? So we have an initial stream of payments for initial choice A, you have a simple method for compounding, right? And in this case, you have your future value, which is your principal times the interest rate, yada, yada, yada. I'm not going to get into the calculations because you guys know that. At the end, you're left with about 6.7 million, right? Choice B. And yes, by the way, if you invested for 20 years, $1 million, right? You would get 6 million compounded for 20 years. Okay, you're going to 6x your money, almost 7x almost, right? And choice B, because this is a stream of payments, so we have to use the future value of an annuity, which is what we call the stream of payments, right? And in this case, your future value is about $5.7 million. This is the reason why you need to understand there is a urgency in the reverse direction in what you are trying to achieve. Many of you think your urgency should be focused on trading. You keep putting money into your trading account and burning it away. And I'm not saying that's wrong. What I'm saying is, yes, that is a needed process to learn. There is a tuition to pay there. But you need to put a portion of that money into your long-term investments first. That's where your focus has to be. Build that pot slowly over time. It has to happen concurrently, okay? I hope that is clear. Like, I'm making myself super clear here that your focus should not be trading first. Your focus should be investing first because you get your feet wet. You're now a shareholder. You get access to the stock market information. You're more in tune with the market. You're not that focused on simple things like the fact that a stock moves up and down violently, okay? It's not going to affect your emotions as much. Investing is much less severe as trading in terms of affecting your emotions, right? You put your money into the entire stock market, yeah, it collapses by 20%. It's fine. You can buy more, right? You can dollar cost into it. Just kidding. It's never going to crash 20% again. So this is my point. Wealth building with assets looks a little bit like this, right? Where you have savings, they are your seeds, right? Your savings are your seeds. And when you take your seeds and you plant them, right? This is what we call cash flow in. Then you put those seeds into investments, which are long or short term, and that's your cash flow out, right? Then what happens? These seeds grow into a sapling. The sapling grows into a tree over time, and you get returns from that tree in terms of fruits, right? Now, many people think that's the end game. And I'm here to tell you that's just the beginning. That is just the beginning, because this is where real wealth is built. This is your next cash flow in that is now feeding the entire system. And this process, as you get more and more into it, compounds and compounds and compounds. Instead of now owning one tree, you own a farm that is producing fruits for a market. This is where you make more investments and diversifications, and that's your cash flow out. And you're using and relying on the cash flow out, not your investments, to make you rich. How are the rich rich? Because they don't spend down their capital. They don't use their principal. They are living off interest. They are living off capital gains. They are living off cash flow from other assets that they've accumulated. So what is the basis of all this? Accumulate assets. Don't accumulate liabilities. Don't accumulate things which are not going to give you a higher value tomorrow than they will today. Okay? So time value of money, as the concept of what I was trying to teach, is that money received invested today will always be worth more than money received and invested tomorrow. If you're a business owner and you are in this chat and you're listening to me right now, remember that if somebody calls you and tells you, hey, I have a check ready for you, right? This is one principle I learned when I was building a business when I was very young. If somebody ever calls you and tells you, hey, I have a check ready for you, you can pick it up, and you tell them that, hey, you can just mail it in to me, or hey, I'll come and collect it next week, you are doing yourself a disservice. Because that earlier that money comes to you, the less liability it is, and the quicker you can put it to use. Remember this principle. It is a very important principle of being a business owner. The cash flows from a business should always be as quick as possible. Okay. All right. Now, next part of this, we're going to jump into a little bit of what are the market participants that you deal with when you're entering the stock market. I know a lot of you have this conception of who you're dealing with on a daily basis. Oh, yeah, I put a trade in. Where does that trade go? Who are you dealing with in the market, right? There are more than one entity in this entire chain. And I'm here to talk about all of them. I'm going to talk about what their interests are. I'm going to talk about how they have counter interests. I'm going to talk about how they affect the entire system. So this is going to take roughly about 10 minutes or so, and then we're going to jump into the next portion after that, okay? Which we will get into right after this 6th point that I'm going to make, okay? Are you guys ready? So I've spoken about the importance of long-term investing and why it causes cognitive biases in your head, right? The urgency complex. I've spoken about the hero's journey. I'm building you guys up to understand that as you get on this journey, you need to pay attention to find things that you're overlooking. These are foundational and characteristical flaws in humans that we often overlook. Why? Because we are in pursuit of an easier path. Humans don't like to work for things. We are hardwired not to, in fact, right? So I have to put this in front of you and reiterate it constantly, okay? All right, are we ready for this? Have you understood everything? Let's just check in really quickly. Have you understood everything that I spoke about so far? How are you guys doing so far? I'm gonna take a sip of my coffee too. Does anyone want to give me $1 million? Yeah, I will give you $1 million. I will. For those of you that don't know, that's my fiance. Very informative. So far, so good. Yes. Okay, great. Hey, where's the energy? You guys, there was like almost 20 people replying earlier, and all of a sudden, y'all like all quieting, like don't die down on me now. I want to hear from you. Let's keep the energy high. Let's keep this going, okay? Let's keep this going. Okay, next, we're gonna talk about the market participants. So when you are entering the journey of trading or investing, right? What is happening? Who are you dealing with? Okay, let's talk about all those people. The first person that is the most important person is the broker. Okay, now the broker has many different names. A broker has the name of a market maker. The broker has the name of a dealer, the name of a market dealer, the name of what else? Counterparty. What are the names of their brokers? There's so many names, right? All these people serve the same function. What are they doing? They are a connection. They are licensed professionals, okay, who are licensed to trade securities on your behalf. Now, most of you might not even know this. When you are trading with the broker, you don't own any of the assets that are in the broker. You guys know this, right? You just become a part on the P&L. You understand this, right? You're an exposure to their balance sheet, right? So when you put in a trade into the broker, sorry, Larry, do you mind muting yourself? Okay, I got you. When you put money into the broker, what happens? Your broker takes your money and has an agreement written with you, right? You accept a terms and agreement, don't you? You put yes, 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 yes. You don't read through it, right? I read through it, so I know what the hell I'm talking about, right? When you accept that agreement, you are accepting an agreement that the broker owes you these shares, but they are serving it to you with intent. Therefore, you don't outright own the shares. Yes, you will still receive prospectus documents of owning the shares. You will still have voting rights and all of that. But this is all done through the proxy of the broker. Okay. So the broker is actually the owner of the shares. They are just lending it to you. Okay. This is why they're able to facilitate so many transactions in a short period of time, right? So, oh, sorry, I think I accidentally clicked on the next slide. My bad. So they are a middleman between buyers and sellers, and they take commissions as fees. This is simple. Their model is very simple. Okay. Now, sometimes what has happened is that over the years, brokers have gone commission free. And what does that mean? That means that you're the product. It's simple as that, right? I mean, if the service that they are providing you is free, then you are the product, right? What is happening there? There are other ways that they are making money. We'll get into that a separate time, right? And I go through this in the course as well. I've gone through this in separate instances. It's too long for me to explain that. The exact mechanism is I will gladly explain another time, right? But through this process, they sell your orders to other people. They buy the orders from you and they sell it to other people. Or if they see that you are at a very low price and you have a stop loss, they will actively try to grab that stop loss because they want those positions back for themselves at a lower price, right? The main important thing to understand here is that they either buy from you or help you to get the highest price for your sale. As simple as that, right? And in this process, what do you benefit from? You benefit from being anonymous, and often they offer you additional services such as level 2 data, analysis tools. They'll give you access to the order book. You will see exactly who bought what at what prices, right? These are all small things that occur when you are dealing with a broker, right? The broker is the connection between you and the marketplace, in other words, but they are self-incentivized. They have a purpose to serve. Now, when you place a trade, the trade goes to the broker. The broker has to take the reverse trade. They have to. Why? Because the aim of a broker is to remain neutral. Okay? They want to remain neutral. Now, at times, brokers, they tend to get biased too. Okay? Because they have a lot of shares in a specific position, they might need to offload those shares. Maybe they are looking to build a position in another aspect. Therefore, they will try to buy at a cheaper price. This opens up the broker manipulation tactics. Now, if I were to explain all the tactics, it's going to take way too long. So what I'm going to do instead is move on to the next point, but I think you kind of get the idea. There is a counterparty risk when dealing with the broker, okay? How many of you knew that? Did you know all of what I just said? The second person that you deal with is a portfolio manager, right? Many of you engage these people. Actually, almost all of you are in engagement with a portfolio manager, right? As long as you're invested in an ETF, you are engaged with a portfolio manager. Who are these people? They manage client portfolios and they take advisement from their team to either buy or sell securities on their behalf, right? Who is a portfolio manager? Kathy Woods. Who is another portfolio manager? Carl Icahn. Who's another one? Peter Thiel. These are Ray Dalio. All these people are they were portfolio managers and they probably still are, right? And ETFs also have portfolio managers, as do family offices and hedge funds or banks, right? The portfolio manager, where does their salary come from? It comes from something called a expense ratio. You guys ever heard this one? Whenever a fund is run, let's say the S&P 500 is run, or somebody decides to create a fund for, I don't know, AI, for example, right? If tomorrow somebody decides to create obviously this one's going to come up very soon. You will see there will be ETFs that will pop up that will allow you to directly invest in AI, right? That person who is building that fund, they're doing work, right? Where do they get that money from? Where does their salary come from? It comes from the expense ratio, and that comes from the pool of investors, okay? Whose portfolio are they managing? Their own or others? Others, right? They may be managing their own too, but they're managing it for an institution. Remember, the focus here is that they take advisement to manage client portfolios. So these people, what is their interest? Their interest is the expense ratio, is keeping the expense ratio as competitive as possible. So you would see that expense ratios are a really important thing. Just like how I was explaining to you earlier with the compounding. Remember that when you see that your investments are compounding, what else is compounding? Your investments may be compounding and growing, but your expenses are compounding and growing too. So you need to pay attention to expense ratios. Okay? The lower the expense ratio, the better, because you want to buy an investment but not pay too much money for it, right? All right. Next up, the stock exchange. This is where all financial instruments, right, are traded. That includes stocks, bonds, commodities, right? That includes your non-listed stocks. These are what we call OTCs or over-the-counter, right? Everything is done in real time according to regulatory standards. This is your NYSE, your NASDAQ, your SGX in Singapore, your LSE in London, right? These are all exchanges in which people can list stocks. Where does that come from? That comes from the primary issuance. When a company wants to go public, they go and list their stock on a stock exchange in order to raise debt from the public. Okay? This is a very simple one. I'm not going to spend much time on it. Next, hedgers. These are teams within a business that usually ensure stability in FX swaps. What is FX? Forex. We're talking about currency here. You ever wonder, Apple does business so many places in the world, right? How do they manage all those currencies? That's what the hedger's job is, right? When businesses operate all over the world, think about Apple for a second, right? They accrue a lot of capital in different currencies, and they need a team of people to manage those currencies. So when a foreign currency is unstable, they have their teams hedge that currency and take the opposite trade, for example, right? And this ensures that their business earnings are stable and not affected. This is the reason why in earnings reports, you would always see a FX swap margin. You would see something of where there is a relation to FX gains or losses in the balance sheet of a business. Go and look at Apple's balance sheet and you will see it, right? Next, investment bankers. These are who we call wholesalers. Not to be confused with market maker. This is a big one. Many of you confuse the two, right? You always think that investment banks are market makers. They aren't. They can make markets, but that's not their primary purpose. Their primary purpose is that they are experts at raising capital. They are the ones that facilitate IPOs. They are the ones that facilitate mergers and acquisitions. They are the private sector's bank, okay? And they ensure all the regulatory standards are met while doing the client's needs, right? Now, important thing, when you talk about investment banks and wholesaling, what does that mean? What does that mean? Does anybody know? The primary purpose of a wholesaler is to do what? Is to buy low and to sell high. Correct or wrong? Wholesalers are notorious. Like, look at Costco as a business example. What do? They buy things in bulk and then they sell it to you in bulk, but at a higher price. Correct? That is a wholesaler. That is the nature of a wholesaler. Taking the same principle, you need to understand that investment banks are the lender of last resort for liquidity to the system. Okay? When you have a market crash that comes in, when you have uncertainty that comes in, these are the whales. Okay? They have the real mullah. The rest of the guys, they're small fish. They're like Nemo and Dory swimming in the freaking ocean. Okay? Investment banks are the freaking whales. They are the big boys. When they come in and step into liquidity, it will be heard. It will be noticed because they don't buy positions in small quantities. They go in millions. So when you see millions of dollars being traded, that's likely a wholesaler. Okay? Not always, but most of the time. And the last of all, the most famous one, the most important one of them all, right? And I think the one that you all probably know the most. Our king, our savior, Jerome Powell, who runs the Federal Reserve, right? The central bank. This is the last piece of the puzzle of the market, right? What is the central bank's job? They are mandated by Congress, which is the US regulatory body for politics, right? To ensure stability of monetary policy, that means interest rates, stability of financial systems, that means liquidity, right? Money supply, payments and settlement systems, inflation and jobs. Yes, they have a very big job description, right? And they operate through a decentralized structure where political influence can't affect policy decision making. Now, this is actually one of the things that I think are good about the US system, right? There are 7 people that make up the board of governors, okay? There are reserve banks, and then you have the FOMC, which is the Federal Open Market Committee that constantly meets and talks about interest rates, okay? These people decide how expensive it is to borrow and lend money. There is also a common misconception the central bank doesn't directly influence interest rates. When the Federal Reserve says that we aim for interest rates to go between 5 to 5.25%, right? They don't just snap their fingers and it automatically adjusts like that. There is a mechanism in place. They do this by buying and selling bonds. That is the mechanism for entryway for money supply. The more bonds they buy, the more money they are taking out of the system, right? If they are selling bonds, then they are putting money into the system. Okay. I've done a whole webinar about the bond market, 2 hours long. It's on YouTube. You don't understand this concept? Go watch that video. And I'll be glad to share it with you guys. So what drives prices? What drives prices in the stock market? Well, there are 4 criteria that I break it down into. The first is supply and demand. The second is emotions. The third is economic sentiment. And the fourth is the actual stock performance. Now, supply and demand is probably the most important one. This is a basic mechanism of pricing, right? Something gets bought up, increased demand, goes higher prices. Something gets increased supply or people want to sell, that's lower prices. And the amount of shares that are going around makes a big difference, right? Emotions, about 90% of the time, when investors or traders make a decision, emotions drive the purchase or selling. This causes prices to go up or lower, higher or lower in extremes because emotions are at play, right? And this can often result in something called irrational exuberance, which is a term that was coined by Robert Shiller, a famous behavioral economist, one of my favorite people alive, right? Emotions is where the hero and ego journey comes in. Exactly. Yes, this is where the link happens, right? Because you're emotional, your ego steps in to protect you, and that may or may not help you, right? Because you have a self-serving bias, you come from a different lived experience, you don't know, you come from a different background, everybody comes from a different background, everybody's situation is different, your urgency might be different, therefore it affects your decision-making for buying and selling investments, right? Now, economic sentiment here, news, sentiment on future projections, on security, technical analysis, your inflation, liquidity, secular trends, expected dividends, these are all falling under economic sentiment. And investors and analysts, they try to predict what the future will hold in terms of something we call growth multiples. How many times can this thing grow, right? It's a very common finance lingo, which I'm not going to get into right now. And the last is the stock performance, actual stock performance, right? So there are 4 pieces to this puzzle that drives prices up and down, right? The actual performance of the stock, how the company spends and invests cash or the excess cash on its margins of profit, and how that contributes to its profits ultimately, right? And what do we use to measure here? We use free cash flow. This is a good measure, right? What is free cash flow? That's money left over after paying everybody out. After paying your debt, after paying your expenses, after paying everybody else, you have something called retained earnings, and that retained earnings goes into free cash flow, right? And so that is a measure of where the company's performance is heading to, right? Remember when Tesla was trading at a shit price for multiple years? What happened when Tesla went into free cash flow positive? It went boom, right? This is the reason why, okay? So how do we understand equity sentiment when we're talking about the stock market, right? The stock market operates in a very predictable fashion, actually. It's a very predictable fashion, but the problem is that people get impatient, okay? The impatience is what causes people to lose money. It's not the fact that they don't know what's coming. This is the funny part about it. People can see what's happening, but the problem is they like to speculate. They love to walk into the casino. I'm going to put some money on red today. I'm going to put some money on black today. Let's see what happens. Woohoo! Right? And then when they lose money, they suffer from loss aversion, which is when they lose money, they feel it more severely. But when they are on a roll, they're like, no, I can make more. I can make more. I can make more. Right? And this is what gets you clapped. This single-handedly is the reason why people blow up their accounts. Right? Do companies usually state projected cash flow as something you have to try to calculate? No, this is all like public information. Like go to Yahoo Finance, you can see projected cash flows on there most of the time. You want to know projected cash flows for something specific, DM me. I will always give it to you. I have the projected cash flows done for almost every stock, like the ones that I trade at least, right? Okay, so the market, it fluxes between three states like a pendulum. I like to think of it like a pendulum, right? Remember in physics, you used to drop the pendulum and then you see woo, 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 right? And you realize every state, right, when it goes this way, it pauses for a brief second and then comes back down, and then pauses for a brief second and then comes back down, and pauses for a brief second, right? There's a pause in between all of these states, right? So a bull market, what does that mean? A bull market. A bull market is a period in which financial conditions are loose, okay? This is where money is cheap to borrow. Capital is abundant, cheap, and this causes investors or traders to lever up. Everybody wants to take leverage here, okay? And what is this? What causes this? It causes a cycle of people taking more leverage, prices going up, more leverage, prices going up, and asset prices balloon higher and higher, right? This sends the prices of things sky high, right? This typically lasts about 8 to 12 years, but it varies, okay? The last secular bull market was about 20 years, actually, okay? Then comes a period of consolidation. This is a period in between bullish and bearish markets. This is where prices are moving sideways. Which year was this? Last year, right? 2023 was a consolidation year. Can we all agree that? Yeah, the market came down a little bit, but it wasn't that drastic, right? Like anyone who says the market crashed last year hasn't been trading or investing for a while. Like you're a complete newbie if you told me that last year was a bad year. It wasn't a bad year. It was just a corrective year. It was a consolidation year at best, right? If you've been in this thing for a long time, like I have, 20% consolidation of market is nothing. This is nothing because when the bull market comes, it runs more than almost 3 times that, right? You will see years and years of back-to-back returns, right? And remember that statistics favor the bull market, right? 75% of the time we are in a bull market, okay? And that's facts. That's facts. It's not made up information, right? Then comes the bear market. And this is the period where financial conditions tighten. That was last year also, right? The consolidation also took place in the bear market. Last year, we were in a very unique scenario. It was a mini bear market, but also a consolidation, right? We moved sideways for the entire year, but very slowly down, right? It wasn't a crash bear market, right? And capital is scarce here and getting expensive. Interest rates start to rise, right? Investors, what do? They take fewer chances, they de-lever their positions, they take money off the table, right? It becomes more difficult for people to borrow and lend money, right? And this often results in crashes, prices going lower and lower, okay? And this lasts between 6 months and 3 years. Last year's was 1 year. So perfect bear market, short-term bear market / consolidation, right? And now we talk about that if you understand the equity sentiment and how the market shifts, right? You understand who the market participants are. You understand how the long-term wealth building affects you. How do we put this all together in the big picture, right? So the next slide that I'm going to share with you, which is the intermarket complexities, is where everything comes together. Okay, this is where the market comes together as a whole. All right, this is the expanded image of the market. So financial markets are made up of a few very important pockets. Okay, the backbone of the entire market is run by one specific thing, the bond market. This is what I like to call the plumbing of liquidity. Sorry for my bad handwriting, I'm trying to use this pad. This is liquidity. Okay? Now, the bond market has an impact on all markets. Okay? There are different types of bonds, obviously. There's government bonds, there's corporate bonds, but this is also called the debt market. Other names for this is the money market. Have you all heard of these names before? Have you heard money market, debt market, bond market? You must have heard all of this. These are all the same thing, okay? These markets tend to be safer in nature and it's usually the most capitalized. Just FYI, about a couple of weeks ago, 2 weeks ago, I posted a infographic for all of you guys to see. There is currently the highest amount of money in this part of the market right now. Can somebody take a guess what that number might be? How much do you think, as of today, is roughly invested in the bond market? Put out a wild guess right now. 2 trillion. Go on, go on. All of you, try and just put a quick guess. Come on, fire it away. 3 trillion, 10 trillion. Ooh, 10 trillion is quite close. The answer is $7.2 trillion. There is currently $7.2 trillion sitting in the bond market, money market funds. Okay. That's a lot of money. And most of this money has come in when? It has come in the past 2 years, just so you know. Okay. This is happening while the stock market is running into all-time highs. And cryptos are in all-time highs. Just imagine what happens when this money comes out of money markets and goes back into other markets. Just a simple thought for you guys, a thought exercise. Imagine when a fraction of this goes back into here. Just think about that for a second, okay? Let that sink in, all right? But I'm going to continue on. So typically, bond markets will move inversely to risk assets. But in last year, we had a very unique scenario. We typically see that when the stock market goes up, the bond market comes down. That happened last year. But now we're seeing a highly correlated asset. The reason why this has happened is because in the short run, investors are a bit fearful about where they want to put their money, okay? And investors are more well-equipped now. They're smarter, and they want to put their money into places where they see returns are higher, okay? Now, there are also more intricate things about this, which I don't really want to get into because we are going to be short on time. But I'm willing to have this discussion on a separate instance if you during one of the pre-market lives, okay? I'm more than happy to talk about it. There's influences from the Federal Reserve here. There's influences on returns that bond market participants want. And that is what has caused the delinking of this, okay? But bond market is also used to control monetary policy. As I was mentioning earlier, the reason why this market is so huge is because the Federal Reserve uses this market to pump and take out liquidity from the system, right? This is why I say this is the plumbing of the system and the most important part of the system, right? This is where money is pumped into the system, right? Okay, you get that now. Next is the equity market. This is the second most important, right? This is the leading indicator of the economy. How many of y'all have friends that till today you talk to them about finance stuff and then they go like, yo, man, I don't quite understand this. Like, why is the market all-time high when like the economy's so bad? Like, we have so many jobs that are going bad and we don't even know what is going on. Like, why is the economy so bad? And why is the market rallying on this? They scratch their heads thinking, I don't know, they can't figure it out why, right? How many of you have friends that say this? Because I'm sure as hell do, right? And I'm not trying to make fun of anybody. I'm genuinely telling you that this is something that happens. And I'm not trying to downplay that they are dumb or anything like that. I'm just saying that the reason why they think this way is because they're not educated. The equity market is the leading indicator of the economy. The economy is not the stock market. The stock market is not the economy. The stock market prices in things 6 to 8 months down the line. If the market thinks that the Federal Reserve is going to cut interest rates in the next 8 months, it's going to start pricing that in today because it knows this information. That, as I mentioned earlier, what is the job of analysts and investors? To figure out what is happening. And this boils down to a very simple psychological and heuristic perspective. This was a study done by, oh, well, what do you know? I'm going to mention Shiller again. Robert Shiller and Amos Tversky. These are two people, you should look them up. They're very, very influential behavioral economists, right? One of the other people who were in the same clan is Daniel Kahneman, who just passed away 2 days ago, by the way. RIP to him, one of my favorite people in the world. He's the one that wrote Thinking Fast and Slow, right? Now, these two people came up with a theory. It's called the efficient markets hypothesis. This is every trader's favorite theory, okay? Because what does it state? It states that all information that is readily available is priced into the market instantly. Okay, instantly. Every single moment that there is information that can be priced into the market, it will be by the market. Okay, that is the reason why the economy is not the stock market and the stock market is not the economy, because the market is forever pricing in information, looking at, oh, what's going to happen, what's going to happen, what's going to happen, right? And therefore, when the new information comes in, it prices it in. Oh, Apple's rumors come out that there is a shortage of shipments from China. Okay, price that in. Sell off Apple stocks. The market immediately reacts, right? That is why the two things are not linked together. Okay. Now, equity markets are also the bridge of capital for investors to businesses, right? More importantly, rallies in loose financial conditions when borrowing is cheap. So when financial conditions improve, when the Federal Reserve announces an interest rate cut, the market doesn't rally then. It rallies 8 months prior to that. It rallies 6 to 8 months prior to the first interest rate cut. When the first interest rate cut happens, the market falls because people take profits knowing that the cuts are already done. The move is already over. Then when the market comes down after the cuts, it starts to rally again. So understand how this works. It's a constant process of pricing things in, okay? And the equity market, lastly, is a store for value for most people, okay? Sorry, let me look at some of the things that were written here now. And that typically happens when interest rate drops, correct? When you thought the market was overpriced, low, we ain't seen nothing. Money cycling from bonds to equities is money markets where billionaires park their money. They could if they wanted to. Some of them do, but not all. I mean, if you're a billionaire and you're parking your money into money markets, you're a dumbass, right? I don't think that's a good use of capital. For people who invest in bond markets, that's like using 2 condoms. You know what I mean? It's like double protection. It's very risk averse investment, right? There's no risk in it. There's no fun anymore, right? Yeah, in an old trading group I'm in, always betting on a crash. Oh yeah, that's obviously everybody is constantly betting on a crash because one time they'll get it right and then they'll be like, oh look, I was right. Once again, what does it boil down to? Ego, right? I want to be right, right? Ego. It boils down to ego, right? But yeah, if you invest in the bond market, that's equivalent to you putting on 2 condoms. It's like the most safest investment, right? And honestly, if you're going to do that as a billionaire, I don't know what you're putting your money towards. Billionaires own businesses. They don't own, bonds. It's not their cup of tea. Okay, so that's the second piece of the puzzle here. You can see how these are connected now, right? When the interest rates for bonds are fluctuating, it affects the equity market. Remember that. Why? Because the Federal Reserve controls interest rate policies. That causes the values of stocks to go up and down. Now, there is another market that is also linked to both of these. What is that? The derivative market. You guys are all very, very, very well versed with this one, right? If you're a trader. Options. This is what you all love, right? You love to trade them. You love to talk about them. You love to fantasize about them, right? What does the derivatives market allow you to do? It allows you to participate, to hedge and speculate on your investments. Okay? Hedge and speculate. Keywords. And what is this used by? It's used by bigger institutions in combination with equities to build risk neutral positions. Read point 2 and read it over and over again and paste it on your wall or something. Because some of you do not understand how derivatives are used. And therefore, because you don't know how it is used, you go ahead and make your own expansions of mindset to think that they are going to make you a millionaire. Okay? When institutions buy derivatives, they are not buying them without the backing of equities. Does that mean, and by the way, in no way am I trying to slander anyone who trades options. I'm just saying, stop doing this shit irresponsibly. Come on. But it's 2024. If you haven't learned some things about the market by now, let me give you the honest truth. Stop taking degen positions in options and start focusing on how institutions are building their positions. if you actually took your time to understand that concept, you would learn a lot more about how to position yourself to win. Okay. Now, I'm happy to once again go through this scenarios with you guys during a pre-market. If somebody reminds me, I will happily go through it. Just ask me, hey, can you teach us once again how institutions buy options? And I will explain this whole thing during a pre-market live. Okay, I'm glad, very happy to do it. Okay. Now, this entire derivative market, what happened? It boomed in 2020 during COVID, right? And it was one of the biggest wildfires ever set ablaze to retail traders. Next, you have commodities. Commodities are inflation measurement. They are also a typical hedge against inflation. Okay. And the last is Forex. This impacts all markets. This is your currency exchange. And this is a big focus on commodities. Okay. Now, these two markets, okay, Forex market is not that small. It's bigger than equity market, but it's more of a trans-governmental market because the biggest movers of currency are governments, okay, not businesses. And commodities are a good one to understand when inflation is in question. Now that we're passing inflation, it's not really a matter of discussion anymore. But because there are speculations that inflation will be higher again, that's the reason why you're seeing commodities rally again, right? Okay. So, as you can see, the markets are a complex environment. They're not as straightforward as you think they are, right? There are a lot of things that are in play here. And so I want to do a little bit of a announcement here since all of you are here and I don't want to lose your attention. For the Discord, during this boot camp, we're going to be holding a 30% off sale. Okay. You can use the code 30 off. I'll put in the email to you guys as well. You'll be able to sign up for the Discord memberships at a discount if you want the premium subscription. However, we are also including a free membership, right? So for all of you that want free access, you can now join the Discord starting now. And here's the link I put in the chat. You can go join up. It will not require you to validate anything. You just click on the link and you'll be in. You'll be assigned the Phoenix role. I'm going to leave this up for you guys. Take a break. Go join the Discord. Look around the server. There are quite a few things for you to have a look at. And then we'll see you back in, let's say, 5 minutes. Is 5 minutes a good amount of time for you guys to take a break? 5 to 7 minutes? Is that cool? Let's say we start at 10:30 again. We don't have much to go. We have maybe about 5 more things to discuss. The second part of this is going to be risk management, so you want to stick around for that though. Okay. All right. See you guys in 5 minutes.
Still going.
All right. Are we ready to rock it and get into this next part? All right, are we all here? Are we ready to go? If you're here, just give me a quick yes. And let's get started on the next part of this. I think for traders, this next part is going to be important. Once again, if you are just joining into this bootcamp, because I know a couple of you just came in, very quickly, there are two things. Number one, we are running a 30% off discount for all of our Discord subscriptions. I know some of you just require some resources for learning, resources for embarking on your journey. You might not require a one-on-one approach. You might not require a course to do so, but you need a live learning environment and you need someone to hold you accountable. That can be a community. There are multiple ways that you can do this. The first way is by entering free into the Discord server. I put the link in the chat. You can enter free. Make sure that you click on that link because this is a good time to enter the Discord, okay? You get weekly trade ideas, you get a public trading room, you get technical analysis, fundamental analysis. We'll be putting out some weekly research reports, daily office hours where you can ask questions, comments, anything that you require, trade recaps, macro updates for the economics and macro and microeconomics. However, the Wolves and Lions, which are the premium members, will be receiving live trading sessions, which we hold almost every day of the week, right? Trading alerts, the trades that I take on a daily basis. And then you'll get access to trading bots and research material. Now, just to give you a little insight on what that might look like, the research reports and the bots, right? We have an entire channel which is called the research reports, which posts institutional grade analysis, right? For example, Citigroup report on what is the next exposure for AI, right? Goldman Sachs trader color tracking. On a daily basis, there is unusual options flow that is summarized for you, right? More importantly, there is options flow that is scrutinized and already summarized for you. It's categorized into three things. This is small, which is below 200,000. This is between 200,000 and 800,000. The golden flow, which is above 800,000 into a million. These are all big money bets that are put in. You'll have access to the stock bot. You'll have access to the tweet flow, which you already have as a free member. This is our carefully curated list of people that we follow. You'll have access to Walter Bloomberg, right? You will also have access to the library, which is a considerable amount of knowledge that I've accumulated over time. If you scroll all the way up here, there are numerous books for you to access. A technical analysis collection, a string trading collection, there's option trading collection, long-term investing collection, day trading collection. There's so much of knowledge here that you can pick up and learn, okay? And that's all about what I wanted to share. Okay, so make sure you join the Discord. While you're at it, introduce yourself to the team. There's an introduce yourself function, and let's get this cracking. So now that we transition over to day trading, right? What is day trading? Day trading is the art of being a master trader. You're buying things at a cheaper price, or you are buying things on the whim that those things will increase in price. There are four factors as to how day trading works. The first factor being the fundamental and macro analysis. What significant economic data impacts your coming week, for example, as a day trader? You need to be on top of this. How are financial conditions? Where is the bond market? Where is volatility? Where is the risk appetite of the market? Right? Next question. Is capital flowing from a specific sector to another sector? If so, which ones? Right? This should be the basics, the bare basics of your analysis. Second, where is the market maker's exposure? Market maker, broker, dealer, same words, right? Brokers and institutions take on investments risk from their investors and traders. They have to offload that risk by hedging it, as we spoke about in the first part of this bootcamp, right? And risk is accumulated by middlemen, which are typically best analyzed by delta or gamma exposure, right? Now, when we talk about this mechanic, we're talking about how much of exposure the average market maker has on their balance sheet. Knowing this piece of information is important because then you can understand where the counterparty risk is for that specific trade or that specific market that you're trying to trade, right? This is one of the reasons why we observe where dealer delta and gamma exposures are in derivative related terms, right? Next, emotional sentiment. What is the emotional sentiment of retail traders, other retail traders like yourself? What is that emotional sentiment looking like? What does the news sound like? Is it pessimistic or optimistic? These are all important things, right? Is it a valid rhetoric? Is the current perception of the market valid or not? This is a question you have to ask yourself. And are emotions swaying in between extremes right now? If you can answer all these questions, then you start to understand this is how day trading works. The last step of all of this is to find out the actual performance of the business also affects prices. How the company is spending cash and investing in, right? And then using all of this information to plan the trade and trade the plan. This is where you get into your planning phase. Okay, now that I know all this information, what are the levels in which I'm going to buy something? What are the levels I'm going to sell something, right? That's important, okay? So, day traders, what do we focus on? We focus on capitalizing on something called imbalance of supply and demand through analysis, right? And analysis comes in various different forms, either technical or fundamental, okay? And what do? We exploit the moves based on a risk to reward opportunity, which we're going to get into later, right? Then on top of that, momentum and volume traded, which is liquidity, is also important. What is momentum? The propensity to buy and sell. How severe is it? That is momentum, right? The main focus should be to capture part of a bigger move instead of the entire move. There is a very common phrase that we use at Timeless Finance now. That's so nice that I'm using the new word, the new name, right? Your aim as a trader is not to eat the whole fish. It's not to eat the whole thing. This is not your aim. Your aim is just to get the most tastiest part of the fish. This part right here, the fleshy part, which is the most tastiest, right? In other words, if this is your demand zone and this is your supply zone, this is where you have the highest potential for earning. This is the highest risk for losing for a bullish trade, right? Your aim is to only capture small parts of this and not this whole thing. The problem occurs is when you try to capture the whole thing. Because what happens when you try to capture the whole thing? The market has other plans for you. It sends you on detours, right? You ever take a trade and then you're like, I'm going to enter here and I'm going to exit here. You buy a specific amount of time on the derivatives, right? You buy the option trade and you're like, okay, I need 30 days for this to play out. But then the market makes that move in 45 days. 2 weeks after you have closed the trade, you look back at it and you're like, oh shit, I would have been right. Why does this happen? Because you tried to catch the whole thing, right? How many of you have gone through this scenario? You get greedy, right? You put in the time, and you might make all the right decisions, but then what happens? You go through the detour. I like to call it the detour because the detour is when the market is slated to go from here to here, but takes a different route. Instead of going like this, it goes like this. Instead, it goes like this, and then here, and then here, 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 and then here, and then here, 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 and then here, and then here, eventually, right? That's more reflective of what the market looks like, right? Story of my life. And back in the day, the OGs will know this, right? If you're really like one of the older members of EGA as it used to be, this is the moment right here, right? This moment right here is where you ask yourself, why does God hate me? Right? Because you get manipulated. You get manipulated out of your position. Market makers have their own incentive. You don't see that coming, right? And it's okay. That happens, right? This bootcamp is supposed to alleviate some of that. Okay, it's supposed to alleviate some of that. Remember how we have started this bootcamp? We started talking about ego, and ego is going to be the one thing that's going to be constant throughout all of this. What is the reason that happens to you? It's because of ego. Am I right or am I wrong? It's because you want to prove to yourself that you can eat the whole fish. You are a big boy and you have the appetite to eat the whole fish. But what happens? The market has other plans. The market humbles you, right? And then your ego dissolves. You go through this enough times, your ego is completely gone, right? And then you realize you're just the market student for the longest time, forever, right? Here are 3 skills that I think you need to succeed as a day trader. The first being a patient mindset. This means that you let things come to you instead of you chasing things. If a stock is breaking out of a key level and you are chasing it, you are for sure going to get clapped. It's a matter of when, but you will. You know why? Because you are now setting yourself up for a repeatable problem that's going to occur. If you're someone who constantly trades something where you see it's breaking out and then you chase it and then you play the upside, 1 or 2 times you'll get lucky, right? The stock will move up and you'll be like, oh yeah, I got it right, right? Once again, ego, right? But what happens? A couple of times when you really think that your conviction is strong, you're gonna get smacked. And at that time, it's very likely that you took higher risk than usual. And that's how the destruction of accounts starts. Because once your risk management is out of play, what happens next? You start speculating and you double your risk. And then the cycle starts to permeate all the way through your body, from your toes all the way to your head, right? So patience is something that even I can't teach you. This is something that you have to learn, okay? You have to wait for the opportunities to come to you. The next is a business acumen. What does that mean? That means you operate your trading account like a business. Low expenses, good margins, and good quality products. That is what builds a good business. For those of you that are business owners, do you agree with me? Right? That means that you don't buy stupid stocks at stupid prices. You buy good stocks at low prices, and you expect good margins. Next, quality over quantity. Buying quality stocks or contracts versus bigger quantities or aiming for huge percentage wins, penny stocks or cheap out the money options, which I like to call cigarette butts, coined by Warren Buffett, right? This is where you really will shine if you stop doing this, right? Many of you try to go for the out the money contracts because they're cheaper. And you're like, man, the higher percentage rate here makes sense. It's a good risk to reward ratio. Your confirmation bias prices you into that decision-making criteria. You're like, yeah, no, this can run. And if it runs, I'm going to make 500 times my money. But what if it loses? What if it doesn't run? Did you think of that? This is where your loss aversion comes from. Right? You're not fantasizing about your losses, you're fantasizing about your gains. This is the biggest problem, right? You need to keep that in check. Quality over quantity. The hallmark of an inexperienced versus experienced trader. An inexperienced trader wants to quickly 10x their account. Tomorrow. They don't want to wait. Who's got time to wait 10 years to double my money, right? No. But remember that risk comes with reward, right? The risk also comes with risk. An experienced trader thinks long-term and treats trading like a business, right? An inexperienced trader will open a lot of positions at once. They will trade based on emotions. They will have improper risk management. They will have no concrete plan or strategy. They will just go by what they feel is the right thing to do. more importantly, when they take losses, they'll take it personally. And then they'll end up revenge trading for making up those losses. I'm pretty sure all of you have been through this, so I don't even need to ask, right? Experienced trader, somebody who's been in there for a long time, they will set realistic goals, right? Focus on capital preservation and consistency. 20 to 40% consistently, right? You create a trading plan, you stick to it. You will only take trades that give you at least a 1:2 risk to reward ratio. And when you take losses, you quickly move on with no ego. Losses are part of the game. Goes back to the first thing I spoke about today. Your ego dissolves. You are now embracing fear and failure. All right. Also, how does short selling work? Do some of you understand the concept of short selling? Because I feel like this should be explained, right? In day trading. When you are short selling, you're borrowing money, you're borrowing stock from your broker, right? Let's say you sell the borrowed stock here, right? And then when the price falls, what happens? You're gaining on that position because as the price falls, when you sell something, the price falls, you are actually gaining value, not losing value, right? Because it's a mechanism of the function for the market maker. And then when they have fallen to the price that you're comfortable with, you are buying them back at a discount. That's how short selling works. Once this transaction is done, you return the stock back to the broker. Okay. So you make money as long as the stock price goes down in the short selling scenario. And the broker will lend you some shares of the stock and sell them on your behalf. You're then debted to the broker. Once you repay the borrowed shares and the surplus or lack of thereof, right? Then it's considered a profit loss transaction and that transaction is settled. Yes, you can short one share, absolutely. And now we finally get into risk and reward. So how do you short sell? It's a mechanism through the broker. So when you have a broker, if you have a broker that you're signed up for, what happens is that the broker will have a function for you to sell. It's like just a simple function where you click, you can sell. In the options world, it's a little different. We'll talk, that's too complicated of a topic to get into right now. But you can also sell contracts. You can be the contract writer, right? So let's move into risk management now. Risk and reward. Many of you understand there is a very basic concept about risk and reward, right? The higher risk you take, the higher reward. Correct or wrong? How many of you know this? Now, this is what we call the EPF, or the Efficient Portfolio Frontier. This was pioneered by Harry Markowitz, a very, very important person in finance. He's the godfather of a lot of financial concepts, okay? The Efficient Portfolio Frontier allows you to map out every single portfolio in existence. So when economists think of things in scale, we don't just think of one scenario or two scenarios. We think of it to answer all questions, right? That's how a hypothesis is created. That's how people win Nobel Prizes. Harry Markowitz won a Nobel Prize for coming up with the Efficient Portfolio Frontier. Don't ignore this on the right side right now, right? I just want you to focus on this right now, okay? Now, we know that the higher the risk you take, the higher the reward. This is your regular risk to reward line, right? But when you plot all of the portfolios that are possibly existent in the universe, you get this, which is the efficient portfolio frontier. These are all the efficient portfolios, might I add. They are efficient because they are on the line, okay? Now, very quickly, this is portfolio A and this is portfolio B. Portfolio A gives you a risk, which is measured in standard deviation or sigma, right, of 10% and gives you a 3% return, right? Portfolio B gives you a 10% risk, but gives you a 10% return. Which portfolio would you rather invest in? Run it up in the chat. A or B? No, you have to choose between them. There's no neither. Hey, come on, guys. Quick, let's do this. A or B, you don't need to think about it so hard. I'm gonna explain it. Just choose one, right? If you don't know, just choose one anyway, right? A, B, A, B, A, B. Okay, I see quite a few A's, by the way. Okay. So let's go through this really quickly, right? Portfolio A gives you a risk of 10% and gives you a reward of 3%. Portfolio B, risk of 10% and reward of 10%. Why on earth would you choose portfolio A? You're risking 10% to make 3% here. You're making 10% to make 10% here. Technically, Hojun, your answer was correct, neither, because the risk reward ratio sucks. But just for the perspective, you have to choose one. You would still choose 10% on 10%, right? I've orchestrated this little scenarios for you guys to learn through experience, because when you are just listening to someone talk and not engaging, you're not learning anything. I need you guys to actively think through these sessions. The bootcamps are going to be very interactive. When you're done with it, you're going to feel exhausted. I give you guys fair warning about this, right? But the idea here is you need to have at least a 1:2, more than 1% risk to reward ratio for any investment you make. Okay. And if you realize all the inefficient ones, if you cut them off, the efficient portfolio line looks like this. You see that? These are how other kinds of things fall under portfolio standard deviation. Bonds are here, right? You see, low standard deviation, low return. Commodities are a little higher. Emerging markets are the highest, high return, high risk, right? And US stocks are somewhere in the middle kind of here, right? A bit higher, but middle, right? Cash is the lowest. No risk, no reward. In fact, sometimes negative, right? Efficient portfolios are always on the line. Inefficient portfolios are not. The main reason why I'm making you understand this exercise is because I want to introduce to you the concept of a risk to reward ratio. And that is also tying to the concept of risk management in trading, okay? Whenever you have a scenario where, for example, you have a stock which is trading at $10, and after a certain duration, it goes up by $1, right? And you decide to sell the stock at $11 after bagging $1 of profits, which is 10%. Your total risk reward ratio here is 1:1, right? Why? Because you're risking $1 to make $1, right? In your mind, you have set up this construct. Remember that, right? Is this a good trade? What do you guys think? No, it's a terrible trade, right? Now look at this scenario, right? You put down $1, same stock, $10. Now my stop loss is still $1, right? But now my expected return is $2. So I'm constructing this trade to my own beliefs. I'm constructing it to my scenario. See, as a trader, what do you have control over? You don't have control over this. You only have control over this. Am I right? So therefore, when you're walking into the casino and you are gonna put your money on DJ and stuff, make sure that when you control this, it is in your favor. Because by controlling this, you are controlling your ratio, the risk to reward ratio. In other words, if I were to only risk 50 cents instead, and I were to receive $2 for that, my risk to reward ratio is now 1:4. That means for every $1 that I put down I will receive $4 back. Now, why is this important? Because as a trader, you want to maximize your wins in the bigger amount of trades you take. It's not because, let me explain to you something. The most common thing that people face is this. When they start off, they get profitable initially. There is no problem. See, any monkey can make money in the stock markets, right? You can make money in the stock markets quite easily. You buy something, it goes up in price, you make the money, right? But very few know how to control the loss. This is the problem, okay? And I'm here to explain to you that when you are controlling your idea of what risk means in terms of reward, you need to understand that on a bigger sample size, this number matters a lot, the risk-reward ratio. Because if you have a 1:1 risk-reward ratio and I took 10 trades, and let's say that out of the 10 trades, 8 of them were winners and 2 of them were losers, and you had a 1:1 risk-reward ratio, so 8 out of 10 were losers, and you took this and you had a 1:1 risk-reward ratio, guess what? You would still be profitable, okay? But now, if I increase the sample size, right, to 100 trades, your 20 losses out of the 80 wins might demolish your account. Do you understand what I'm saying? If you understand what I'm saying, say understand. So when you increase the odds of you succeeding in a bigger sample size, that is where your edge is developed. This is where you can become profitable. It is not about being right. It is not about always being wrong or anything like that. The main focus has to be the statistics of the data. The bigger sample size. Imagine if I multiply this out, right? Just hear me out. From 100, now I go to 1,000 trades, right? That means if I'm going through the same win rate, 80% of wins and 20% losses, how many of these are losses? 200 losses. And you would have made 800 successful trades. If you don't manage your risk properly during the 200 losses, you will blow up your account. This is the reason why winning rates are BS. Any advertisement that you see, any furu that you see, any trader that you see that is promoting their win rate is a complete dum-dum. I can have a win rate of 50%. No, you know what? Heck, I can have a win rate of 45% and still be profitable. Do we agree? Do you understand this principle? Because your winning rate doesn't matter. It is your risk to reward ratio that matters. The amount that you're risking per trade and the win that you make per trade matters. Okay? So if you ever hear someone talk about win rates, just tell them, shut up, fool. Say, timeless finance taught me otherwise. So, as I was mentioning, why are risk to reward ratios important? Because you can be wrong 3 out of 4 times on trades and still be profitable with the right risk to reward ratio. You can have 3 out of 4 trades wrong and still be profitable. Because if your risk to reward ratio was 1:4 or 1:5, right? Then that one loss or the 3 losses would be paid for with the many multiples of returns, right? So keeping this ratio high is very, very important. And you can also be right 3 out of 4 times and still lose money because of bad risk to reward ratio, right? See, with the 1:1 risk reward ratio, your win ratio required to break even is 50%. With the 1:2 risk reward ratio, your win ratio drastically lowers to 33%. With the 1:3 risk reward ratio, you only need a 25% chance of success now. The higher your risk reward ratio goes up, the lower the win rate required. This is the reason why you need to keep an important rule of discipline and consistency in order to keep your RR uniform. Okay? What is RR? It's the amount that you are risking in a trade compared to how much you're hoping to get. And your win ratio is how many trades you win out of all the trades you take. They are two separate things, okay? Very simple point, right? So when we are talking about your day trading journey, it has to start with these principles. Let's recap what we spoke about today, right? The first thing being your ego. You realize what is it at every single step of this way today? What is the common theme? It is your ego, right? Your psychology is affected by your ego. Your emotions are affected by your ego. Your ego is constantly trying to jump in front of you to protect you. How do you solve that? You have to be an observer. You are not trying to control your ego. Remember that. You are not trying to artificially put yourself down. That's not how this works. You are observing. You are simply an observer to your emotions, your thoughts. Today, something happens, you feel angry, something happens, you feel distraught, you feel anxious, you feel stressed. Observe it. Oh, wow, interesting. I'm feeling like this today. That awareness is what you need. The awareness allows you to be an observer from a third party angle. Once you have developed that perspective, now you can start to work on the emotions, work on the extensions of your ego. Does everybody understand this? What did we talk about after that? We spoke about the importance of the passive versus active investments, right? And I spoke about how urgent it is for you guys to start long-term portfolios. What was that all relating to? Ego, because you are constantly putting it off, right? Why? Because you don't know much. And you're putting it off because you don't know much. Why? Because you don't know how to get started. You don't know how to get started. Why? Because you are in a cycle where you don't want to seek for help. What is that? Ego, right? Put your guards down, okay? I went through the importance of investing early. We spoke about time value of money. The concept that money worth today is always worth more than money tomorrow, right? Then we spoke about who the market participants are, right? These are all building blocks of what I'm trying to teach you guys, right? And then we spoke about what drives prices up and down. We spoke about equity sentiment. We spoke about intermarket complexities. These were all the basics of what you need to understand as a day trader and investor. Then we took a little bit of a break where we spoke about the discount and the release of the free roll, right? Then I started talking to you about how day trading works, how all of these concepts are connected, right? How the imbalance of supply and demand is what we aim to achieve. The three skills you need, how short selling works, and then an introduction to risk and reward, and ultimately ending with risk and reward opportunities, right? So we are at the end of this class today, and tomorrow we have still a lot of topics to be covered. What are we going to be doing? The first half of class tomorrow, we're going to be talking about psychological and heuristic biases. We'll be talking about controlling and managing your emotions first. We'll be talking about using TradingView intentionally. I will show you guys how to use TradingView intentionally, properly, like you are supposed to as a trader. I will talk about candlesticks a little bit, the deep dive of candlesticks, not the basic stuff. I think that you guys have enough of resources for that. Let's deep dive into candlesticks, right? And then order execution tips. I'm going to go through those things with you guys. What are some things that you might be not really looking at when you're doing order execution? And then we'll finish tomorrow's session with supply and demand. The next day after that is going to be a banger day. You have to attend the last day. It's what sums up everything. I highly recommend that. Okay. So, how's everyone feeling? Let's check out really quickly. How's everyone feeling after this session? How's everyone feeling after this bootcamp day one? Did you feel like you learned a bunch of things that you didn't know before? Like I need to check my ego. Hell yeah. Damn straight. Everybody needs to check their ego. Even I do, trust me. It's the reason why I'm one of the important things that I live my life by is being as humble as I possibly can, honestly. Like it's super important. I will never ever put somebody down or try to, act as though I know more than somebody. If somebody needs information, I will actively share it. That's just the way that I do things, right? Really good. Can't wait for the next session. That's awesome, George. Way more informed. Thank you, Corbin. TCS tired, Caddy. I know. And next 2 days are going to be even more tiring. I've given you guys a fair warning before this all started. Every section's going to be intense. Okay. And honestly, it's good that they are. Real growth happens on the brink of discomfort. And the more you guys engage with me during these sessions, the better your learning outcomes are going to be. So, as I said, I'm gonna call you out if you're not engaging, right? But I really need you guys to engage because that's where the real growth happens, where you're out of your comfort zone, right? You go to the gym, don't you? If you go to the gym every day and you lift the same weights and you do the same cardio every single day, are you gonna grow? No, right? If you're trying to put on muscle, are you eating the same amount of calories every day? Are you gonna grow? No, right? If you're working as any profession and you don't do better, are you going to keep that job? No, right? So why do you think that being in the same spot as where you are today is going to get you anywhere? As even in a boot camp, that's the reason why it's called a boot camp. I didn't call it a workshop for a reason. It's a boot camp because I'm about to kick the boot. That's why, right? I'm about to kick you and make sure that you're moving. That's the job of a mentor. If you are seeking help, you seek help from somebody who's going to kick you and put you into action, not just be passive and be like, oh yeah, so how are you doing today, guys? Right? I'm not like that. I'm sorry, that's not me. And that's just the way I do things, right? I'm real. I'm real. I'm going to tell you straight to your face the way it is, right? Excited about the next 2 days. That's awesome, Mac. Absolutely looking for next 2 days. Thank you, Lewis. Yes, it was awesome. Ida, thank you. Rage, I don't have to eat the whole fish and shouldn't try. My aha moment today. That's beautiful, right? I think that's great. Lastly, if you haven't joined the Discord, do that. Please don't wait. Do it. I'm going to potentially put a cap on 100 people joining. I know today we had a lesser turnout than expected, but I know why. It's a Friday night. Everybody's out. Nobody wants to be at home at 9 p.m. doing a boot camp. They just signed up because they wanted probably the recordings, which they're not going to get until 2 weeks from now. Just so you know, the people that turned up for class, right? You're in this class, you're going to get the recordings right away, right? So I appreciate each and every one of you for turning up today. Give yourself a goddamn pat on your back for doing this on a Friday and committing to this for almost 2 hours, right? I appreciate you. And then finally, if you have any questions, put it in the chat right now. I'm ready to answer any of your questions. And for everyone else that needs to leave, it might be late for you and things like that, please, you're free to leave. If you want to stay behind for the questions, you can stay behind, okay? Been following you for about 2 or 3 years now. Really glad that you're still doing this. Thank you, Benson. Hey, Benson, you've been following us for 2 or 3 years. What do you think about the new logo, though? You like it? I really love it, guys. I'm really excited about this logo, to be honest. Like, I really think it captures everything that we're trying to do. You guys get it, right? It's the F in the middle with the kind of loop around. This is a clock. You know that, right? And that's why it's timeless finance. We're going to be creating generational lessons, guys. We're going to make generational change here. That's my legacy. That's my purpose. I know what my purpose and legacy is. I want you guys to be able to teach your kids how to invest and trade. That's what I want. Yes, while at the bar, needed to see this content. What? Wait, what? You're at a bar? Jetney, are you at a bar? Thanks, Steve. Always a pleasure. No problem, Chris. Looks cool. Thank you. I'm trying to make generational wealth, Jason. We're gonna do that together. Don't worry. How do I get over blowing up a big account and being fearful to trade? Okay. This is a big question. The first thing you need to do is stop trading. That's the first thing you need to do. Stop, completely stop. If you have lost a big sum of money in the stock market, obviously something is not working, right? So stop trying to put more money into it. It's like a furnace, it's just gonna keep burning up. That's step number one. Number two, seek help. Seek help from somebody who is willing to give it to you and willing to do it in a fair exchange. That means that you're not just paying this person for their knowledge, you're paying them for accountability both ways. You're looking at one such person, right? You can reach out to me. I'm happy to talk to you about it. I will be giving that as an option to everybody tomorrow during tomorrow's bootcamp. I will be talking about what the one-on-one session can do for you guys. Okay. If you need help like that, I suggest you schedule a call with me. We can talk separately because there are likely to be very specific problems that you're going through that are very, very specific to you. And I believe that there are people here who are going through one-on-one sessions with me. Is there anyone here who is going through one-on-one sessions with me right now? Right? Mentorship, private mentorship. I believe there are. Yes, there are. Peter is here, Jason is here. Now, they can tell you firsthand what a one-on-one session looks like. It's more tailored to every individual and their fuck-ups, right? And that's an important thing. Right before I continue, let me stop the recording real quick. So this is where day one ends, okay? Because we're going to be posting this on YouTube at some point down the line. So thanks for tuning in to the recording.